Hello, everyone. Uh, Wade Comeaux and Jeff Johnson with Catalyst today. Very excited to go over the monthly market update.
Hello, everybody.
Is my image up right now?
Yeah, no, you're good. I can see
Okay. Not sure. Okay, great.
you.
Uh, yeah, as most of you know, I'm the founder and CEO of Catalyst, and Jeff is our director of lending. We've both been here since day one and are excited to talk to you today about the monthly market update. And then we can go to the next slide. We'll give a brief disclaimer. We are providing general information only. None of this is intended to give any investment advice. We are not recommending any particular investments or guaranteeing any rates of return. And by attending, you acknowledge that we are not responsible for any liability in the presentation today. All right, next slide. Jeff, you want to cover the value proposition?
Sure. So for those of you that aren't familiar with Catalyst, what we do, we are a one-stop shop lender for real estate investors. That is our primary focus. So we provide hard money loans for people wanting to get into investment properties either as a flip or rental. We also provide long-term loans. So for buy and hold folks, we have a lot of good synergies between the hard money and the refi, or just regular, hey, you want to pull cash out of a property. We have a lot of good products, especially on the DSCR side. So if you're not familiar with DSCR or non-conventional, it basically means you don't have to prove your income to get qualified. You can use the cash flow from the property as the income. So it's a great way for investors who maybe don't have a W-2, write off a lot of stuff, to be in the rental game. Just a few more highlights. Like Wade said, we've been in business for 12 years, done thousands of deals. We've also been investors ourselves. So we understand what investors, wholesalers, everybody's kind of going through the whole package. We aren't just a lender. We understand the concept of investing and what people are trying to accomplish. Very proud of 5-star customer reviews on Google. Like I said, we do hard money, conventional, primary. If you need to pull cash out, maybe of your primary, we can do that as well. And then the last thing we have, it's tailored towards buy and hold investors. It's called a bridge appraisal. It's a way for you guys to minimize your risk of a backside appraisal coming in light. So obviously, there's more details to it. If you're interested in learning more, reach out to us, talk to a loan officer, give us a call. We're happy to help.
Absolutely. Great job. All right, diving right into where our headquarters is in Houston, Texas. Um, so some interesting data. Sales are down slightly, nothing of significance there. The average sales price is up 2%, median down 1%. So relatively flat, which is what we've seen for a few months now in the Houston area. Months of inventory up slightly from last year. The days on market up as well. So it definitely is a little bit of not a true buyer's market, but closer to that than it has been at times in the past. And we are seeing a lot of investors get really good deals right now. You've said this the last couple of times. Got to be a little bit more cautious on your flips because they're just not flying off the market. But as far as buy and hold investors go, that is doing really well right now. You can see the total number of lease listings is up. The total number of new listings is just slightly up. So I think that the rental market's doing pretty well. That's also relatively flat. But overall, I think that the buy and hold investors are definitely pretty aggressive at the moment.
Yeah. I It seems it's kind of like more of the same. Obviously, the big thing that jumped out to me was the days on market relative to last year, 21 days. That's a pretty significant jump. I looked at what it was at last month. It's not as significant. It was in that same range. It was an increase, but not much. So that's one thing to be mindful of if you're looking to flip. Just kind of understand. Okay, I'm doing my calculus. It's going to take me probably 2 months to sell it, another month to close. So you just need to bake in and probably 90 to 120 days of holding time for the sale process. The good news is that the prices are still pretty flat. So you're not seeing this, even though the days on market is up significantly, you're not seeing a price reduction, right? They're pretty even keel. And then the other thing I look at is, to your point, Wade, is the opportunity. Because if you just look at sales relative to listings, go back to 19, 7,000 sales and 22,000 listings. February last year, 6,000 sales to 49,000 listings. And then again, 6,000 sales to 55,000 listings. So properties are sitting on the market a lot longer. So like I said, as a flipper, you just need to build that into your calculation. But as an investor, it tells you there are roughly 50,000 people that want their home sold, and they're more likely to take discounted offers. So, as an investor, you should see this as an opportunity to make somebody's day on those sales, but at a deep discount, because you're going to have more chances. It's not like people are getting into bidding wars right now. You're more likely to get better deals. So, investment buy and holds, very steady. Houston's a great buy and hold market. There's still a lot of factors in the economy that say it's still tough for people to get into their first home. So it floods more of a rental market. So you shouldn't have a lack of renters, but it's just an opportunity to pick up a lot of these deals at a discounted price because there's just so many for sale.
For sure. All right. Let's hop over into the Dallas market. And Dallas is a similar story in some ways, but definitely not nearly as many active listings, comparable number of total sales, but like significantly fewer active listings. Also relatively flat on price. But no real movement one way or the other, slightly down. Months of inventory, still, this is both on days on market and months of inventory. It's a better picture than what you see in Houston at the moment. And very interesting thing is that the lease listings are pretty significantly up, and then the average lease price is up 5% in Dallas, which is a pretty strong number compared to the other markets out there in the other major metros whenever I went through this. So while the home prices are flat, the rents really seem to be bumping up there, which is a good story.
Yeah, I saw the same thing. The rents, that's a pretty significant jump year over year, right? $150.
Yeah,
Houston was flat. We'll get to San Antonio, but spoiler alert, is pretty flat. Like Dallas has a big jump in rentals, and one of the articles I was reading talked about like how Dallas is a really strong rental market right now. Just looking at the top line, and the sales are down and listings are up, so it's not nearly as extreme as say a Houston is with the number of available properties versus the number of sales, but it is going in the same direction where there might be a few more buying opportunities. But again, prices are flat; they're not dropping, and we always, we talk about a lot of buy and hold investors. Especially now that rates are higher, cash flows are a little down. But if you just look at, for example, February 2019, if you were to buy a property, and let's just say that you weren't making any cash flow, let's say it was flat at that time. 7 years later, you're up $900 a month. Now, obviously, some of that gets gobbled up by taxes and insurance, but not $900. Like that's
yeah.
significant. So, rents are a pretty consistent increase. You buy a deal, your rate's locked in. Rate's not going to get any higher. If you get to the opportunity to refinance, you can take advantage of it and get a boost to your cash flow. But just especially in Dallas, the rents are outpacing the cost by quite a bit.
All right. What are you saying in San Antonio there, Jeff? You alluded to it earlier.
Yeah, I was really just talking about the leases. Like in San Antonio, the prices are kind of flat, so you don't have that big bump. I guess we don't have 19 data for rentals back then, but I was reading an article. I'll go over the numbers. So if you look at the total sales, they're down 6%. The volume listings are down as well, though. So it's not like Houston and Dallas where sales are both down, but listings are both up. Sales are down slightly, but so are listings. So it's not really throwing that ratio out of whack in San Antonio. Not much change. Average prices are the same. Median's actually gone up. If you look back, the median in Houston, Dallas were down a little bit. median in San Antonio is up 34%. And it's actually, maybe a year ago, we were talking about San Antonio as, hey, why is it so down? It didn't feel right. And it seems like it's corrected because if you look at 2019 to 2026, median sales price in San Antonio is plus 34% over that time frame. Houston is only 29. So San Antonio has caught up and surpassed Houston, at least in the median category. So, it's a good rental market. We've been talking about articles we read for the past year now about how San Antonio is a great opportunity. I will say the days on market 101, that's a big number. So
That is a big number. Yeah.
if you're looking to flip a property in San Antonio, like we always say, it's all about the buy. You need to understand your numbers, understand how long your rehab is going to take. If you're going to sell it, okay, bake in 3 months to sell it and a month to close. So just use those calculations when you're making your offers is what I would advise.
I would, I appreciate your sentiment. I might beg to differ a little bit. I don't think you have to bake in 3 months to sell. I think you have to be buying at the right price, listing at the right price, and then making it the absolute best product on the market. I don't think the best houses take that long to sell. I think it's the ones that are overpriced, and I don't think it just takes somebody 90 days inherently to make a decision. I think there's a lot of houses that hang out for a while. So, but what you have to be able to do is buy at a price where you can put enough into it to where it is the most desirable house in that marketplace. We have some flippers right now that, on Houston, it's taking a long time to sell. But we have one couple, the wife is an agent, husband's a contractor, and they consistently list prices above the top of the market. They set the market every time because they put out a fantastic product. So, and they sell fast. So I know that's what the averages say, and you need to be aware of them. But I think it's just more important than ever that you put out a fantastic product and you price it well so that you can move it fast. Because I don't think the market's just going to say no one's going to make a decision for that long if it's a hell of a deal, you know.
Yeah, that's you. And I know you talk about this a lot, especially when we were doing more flips. But like the market tells you for the most part.
Yes.
I mean, if you have a price, if you put a house on the market and you price it out and you're not getting anything, like let alone offers and closings, but like if you're not getting any bites at all, that tells you there's a good chance you're overpriced. Listen to the market and be
Yes,
aggressive. Don't wait too long.
yeah, because you're never going to get a better offer than the price you get in the first week or two. Never, right? It's only going to get worse. People start to question it, right? At first, they have a fear of missing out. Eventually, it becomes a fear of I'm the idiot, right? Like, oh, I'm going to buy the house after 120 days. How did everybody screw up for this, right? So, you really want to have that good, attractive pricing in the first several weeks. To Jeff's point, if you're not getting any showings, you need to drop fast. Like we normally have a policy of dropping in the first week if we're just getting no activity, because normally people are really, really aggressive in those neighborhoods if it's a good deal. All right. All good points. Austin. So Austin, total sales are down a good bit. Total active listings are up 71% from back in 2019. So quite a few properties out on the market, and that kind of comes through months of inventory. They say, that a buyer's market is 6 months plus, and we were at that in Austin. So that is, I'm sorry, a seller's market. No, yeah, buyer's market. Sorry, I keep backing it up. It's a buyer's market. Over 6 months. That means that buyers had the advantage, and they definitely do there. So you see a lot of indicators here that the market is not flying off the shelves. 91 days on market, 6.5 months of inventory, median price down about 4%, sales down from 2019. So a lot of indicators there. So there are definitely some good markets. In fact, we're going to be closing a really big flip in Austin this week. People are still doing really well there. But it's the same theory. You just have to have a fantastic product that differentiates itself. And they normally don't have the product sitting out there nearly that long. And I was reviewing some comps and everything. Even though this is saying 91, tons of really good properties are popping off the shelves in well under 30 days still at this point. Just has to be a differentiated product.
Yeah, I think I'm calling. I think somebody got lazy on the total active listings and they just threw a number out there. Exactly 10,000. But Austin, Obviously the numbers are down as far as the sales price goes, um, but it's still, if you look at just the median prices relative to the rest of the state, it's still the highest, right? A decent amount too. And I don't think that's going to change anytime soon. Enough jobs are pouring into Austin still, and have that I think that that's still going to be a very desirable place. I don't see it dipping below DFW anytime soon.
Yeah,
Just so much
for sure.
smaller too.
Yeah, that average lease price down 9%. That is a big number.
It's significant, yeah. And don't get me wrong. I mean, there are going to be markets or months or time periods where rents may seem down or are down, but over the long haul, and there's the data to support this, but over the long haul, your rents are going to consistently go up and outpace your expenses.
Yeah, well, they just had a huge run up there, an
Yeah.
unreasonable run up in COVID is what really happened. All right. So some interesting things on the next slide on the tax front. So there was some relief on taxes with the homestead exemption. Also, uh, for the first time, I believe, a cap on annual increases on non-homestead properties, which is really good for landlords. Now, Texas property taxes do remain among the highest nationally at 1.6 and 1.8%. But there's a couple things to keep in mind. If the average home price in Texas is half what it is in California, even though the percentage is higher, you're still paying significantly less, not only in taxes, but also in your mortgage payment. And then I did see a really good chart that I pulled up here just for reference. It's not in the presentation, but the overall state tax impact is the seventh best in the state of Texas whenever you bake everything in, because obviously we don't just have property taxes, right? You have uh, sales tax, you have state income tax, you have a wide variety of things. Texas is the seventh best overall when baking everything in. We're going to go through the migration rates and everything, but overall, when you look at it, still attractive. That's why so many people are moving here. But this cap is big, and you want to make sure that you keep an eye on that because they're. I tried to do a little research before we got on here to see exactly how it works whenever someone buys the property new. Is it 20% from previous ownership? I could not definitively say but that would be interesting if true. But I think it's only whenever you're in ownership, but I'm not absolutely sure on that.
Yeah, I mean, this is pretty significant, right? I mean, being able to increase your exemption to $100,000. You're not going to have a 20% cap. So I am curious. So I don't know, Wade, I apologize if you mentioned this or not, but like if somebody were to the 20% cap on increase, a lot of times they're buying these, because if I'm reading this correctly, non-homesteaded properties under 5 million are limited to a 20% annual increase in appraised value. So a lot of times if you're taking just a garbage house and remodeling it, an aggressive county could blow that up. And I don't know, I'm not a lawyer, but it seems like that's not a possibility anymore. Like they aren't going to just take your value and say, hey, you fixed up a property, it's going to go from 100 to 200.
I couldn't determine that for sure.
Yeah.
I don't know if that's whenever you own it or if it's tied to the owner or to the property. I could not determine that. I discussed that earlier, but I don't have that answer. But David, if you'll put that down, we can make sure and have it on the next webinar. We could definitely have that answer, whether it applies to the property or whether it applies to the owner. I have a tendency to think it might be the property, but I could not definitively find that.
Yeah, no, I think it's probably the property. I know in our world, like rehabbers, you're gonna significantly increase the value of property. So that could buy you a little bit of time to where instead of this massive jump in the value.
Yeah. David, I don't know if you can find that answer by the end of the presentation. I looked around for it some, but I could not find it. But maybe that's something that could work. Okay. Uh, Next slide. What do you see here, Jeff, about the corporate reloads? Another reason why the
Yeah, I mean it's just kind of what we've been talking about. Like you said, I didn't know this until you just said it, but you said overall taxes, Texas is in the top 10 as far as the best states to live in. So when you couple that, extremely friendly regulatory environment, uh, low taxes, low cost of living, big state with a big talent pool to pull from. A lot of these companies are deciding the grass is greener, right? The United States. You have choices to make where you live and where you build your companies. And Texas has become extremely um, favorable, and folks want to come do business here. So they are moving. It's nothing but good for us. Creates more jobs, more opportunities for landlords. It creates more rental opportunities because if you're relocating, a lot of folks will relocate and rent to start. So it's just nothing but great things for the state.
Yeah, I think people moving is one thing, but the jobs moving, these high-paying jobs, these are more normally, um, you know, corporate headquarters or tech companies are normally definitely paying in the higher end of the range compared to the average job. So that definitely has a ripple effect on home prices and appreciation and desirability. So a lot of big wins there. Those are huge names, right? Tesla, Oracle, Charles Schwab, Chevron, huge companies with lots of employees. I thought that was a pretty telling number that 10 Fortune 500 companies have moved since 2020 from the state of California to Texas alone. That's, if I'm reading that right, that's powerful.
Yeah, no, that's correct.
All right, next slide. This is an interesting slide. We've talked a little bit about the big investors and smaller investors, right? And there's some we did a presentation a few months back, talked a little bit about an executive order. I haven't heard a lot of that on how it's being implemented thus far on big institutional investors being limited on buying properties. But I did think that this was an interesting chart talking about how through 2025 the investor activity remained pretty steady, but you have some spots here where it is really hot across the state of Texas. You've got McAllen and El Paso, where there are a lot of investor activity, significant amount of small investors too. Um, and we got some other cities, we've got Corpus, looks like Dallas, Houston, San Antonio, all on this top 20 list here from major metros. So a lot of investor activity, which is logical because the home prices are reasonable and the rents are strong. So the math really works well. But some interesting particular pockets that it's happening a little bit more heavily. I remember we did a presentation probably a year ago, and McAllen came up on one of those lists too. It does seem to be a real hot spot. And I also saw another chart the other day talking about we had a person we do a lot of business with talking about what's the town where they're building that big data center. What is that?
Taylor, is it Taylor?
No. Anyway,
Oh,
I'm not
Abilene, maybe.
Abilene, yes. And I saw that they have a 95% year-over-year increase in building permits, which is the largest in the state by far. So, very interesting stuff going on there. So, a lot. It's not just the major metros that are growing either, which is interesting.
Yeah. I thought it was interesting. I read the article a little bit, and it was interesting. They said because they're talking about the large institutional investors, and they will hit. It's more of a sniper than anything else. Like they will find certain cities, and even within those cities, certain zip codes where
Hmm.
they will go all in. Like I was reading something that said because it was Houston. It said, let's see, over a quarter of Houston's 40,000 institutional purchase over the last 7 years were clustered into just 10 zip codes, where they grabbed like three quarters of the like investor deals were done by large institutional investors. So I think it's one of those things where if they kind of zero in on a certain zip code across the country and they say, hey, for whatever their analysis is, like they think this is the spot to be. And they go all in on those tiny little pockets. So unless you're in those markets competing in that particular zip code, it shouldn't really affect the average mom and pop investor.
Yeah. What do you see on this next slide about investor activity? I thought this is pretty exciting, honestly. Shocking.
Yeah, so I'll just read through it. So early 2026 report, investors account for 30% of the home purchases. So this year, and this is kind of what I was talking about earlier, this year is historically elevated compared to the pre-2020 baseline of 15%. Houston and Dallas were number one and number two as the most investor purchases nationwide.
Wow.
So that's That's pretty strong. Um, the majority of the purchases were non-institutional buyers targeting entry-level homes. So buyers making cash purchases highlight the major competitive advantage. So, kind of what I was talking about earlier, in that Houston and Dallas are hotbeds for investor purchases, and the fact that we're 30% relative to 15, so we're 2x what the baseline is, that just tells you the kind of market that we're in. That it's interest rates are higher, prices are higher, wages haven't followed that, and the first-time home buyers that would be buying these houses, they just can't afford it right now. So this is kind of where this gap is being filled. Those folks that are hitting the age where they'd be buying their first house right now, if they can't afford it, they're gonna, they probably want to live in a house and rent. That's why you're seeing investors buying 2x what they normally do relative to the pre-2020 days. It's just
Yeah.
the market.
Yeah. The other thing I'll say about it's not just number one and number two. You look at you know, Atlanta's not too far below the other two, but then everybody else is pretty much half of Dallas.
Yeah.
I mean, it's not just like this big bundle of 20 cities that are relatively comparable, and Houston and Dallas just happen to be at the top. Like there is a massive, massive difference there. So that the good news about it is that most people on this call probably live in Texas and have much easier access to invest in areas that are obviously desirable, right? So that is a really, really big blessing. I mean, I do think you can invest wherever you want to invest, but it does make it more convenient and easy to be near the places which you want to invest. And we happen to be in a hotbed for that.
Yep.
All right. So this next slide, we're always talking about what are the reasons that you think property values are going to continue to appreciate in Texas is in demand. And it's that simple supply and demand ratio, right? That's what drives all prices in a free market economy, supply and demand. And Texas remains a top inbound migration state, adding 470,000 residents annually in the past 3 years. That's an amazing number. Um, and then population growth in Texas outpaces at 0.5% annually, consistently outpaces the national average of 0.3. So it's not quite double, but in the range of it. But the real telling information is on this slide here. Just looking at the statistics, as far as major, because this is a percentage from where they are. So the fact that Oklahoma went up plus, 26.4 is not nearly as big of a raw number as Texas being up 23%, right? Because Oklahoma has significantly lower population. But look at for major states.
Yep.
Really, no one's in the zip code of where Texas is. If you're looking at the major states, you're talking the biggest population states: New York, California, Florida, Texas, Georgia.
Pennsylvania, Georgia, I guess.
Yeah,
They're
really,
all down.
really, yeah. Now, South Carolina, that is an incredible number, plus 80%. And Tennessee is a big number too. That's a pretty major state. It's got solid population there. A lot of the others are much smaller states, but that Texas number really, really impressive, and that's why I think, even though we're not seeing big time appreciation at the moment, I think that has a lot to do with interest rates. I do think there's a lot of pent up demand from all these people moving here.
Yeah, I think. Well, I bullet number two for people on this call. It seems that's pretty relevant, right? Net migration is a leading indicator of rental demand and occupancy stability. So, if you are in the rental property business, seeing Texas at plus 23 has got to make you feel good that in the long run, you're buying rental properties in a good spot. You're talking about the supply and demand. And the reason why I don't think you're seeing, even though all of these people, because if you think about it logically, so many people are moving to Texas, you would expect, and this isn't just like this year, this has been happening for a while now. You would expect prices to go through the roof, but they don't. And that's because of our regulation, our ability to build new, like our lack of obstacles that maybe you would have in some other, I guess, blue states, if you want to call it that. But like you have states that do not make it easy to build properties, and Texas is not that. We encourage new construction. Like we haven't done it in a while, but Houston and Dallas for years had more permits than other places, like the entire states of California combined. So it's a it's definitely all good things pointing to the state.
Sure. Absolutely. All right. Um, Jeff, what are you seeing on this one? Hill losses?
Yeah, so we live here in Houston. We don't see it as much. People in the northern part of like Dallas, I think that's probably the hail capital of the world. But hail losses now rival major hurricanes. So more than 43 million U.S. properties are at moderate or greater risk from damaging hail, according to a new report, which finds hailstones can now cause financial losses comparable to a Cat 4 hurricane. So if you notice your property insurance going up, in 2025, the U.S. recorded 142 days with damaging hail, 7 more than last year, well above the 20-year average of 122. Um, I will say that little last little bit down there. Roof claims now account for majority of hail-related insurance payouts, with the typical roof being 8 to 25K. I do know that if you're in a market that has hail, you're buying a rental property, maybe the roof is 50-50. You hold on to it for a little bit, patch it up, and pray for a hailstorm to get a free roof on the insurance company. But yeah, no, it's a real thing. And as an investor in Texas, and probably more so in North Texas, you just got to be aware of your insurance premiums and make sure they aren't getting too high. Don't get surprised by the cost, is really what I'm saying.
For sure. Very true. All right, this next slide from some information from Steadily, talking about the overall rental market out there, but some highlighting some Texas things. And as we know, Texas consistently ranks at the top because of strong rent ratios, population growth, and landlord healthy laws. Um, and the rent to price ratio really strong too. I was looking at this, and like the national average is normally between zero point 0.5 and zero point 0.6, and the ratio here is between 0.7 and 1%. And that's just a massive difference because, well, these subtle differences, like when you were talking about Dallas going up $150, whenever you think about $150 relative to $2,500 average rent, that doesn't sound like a big number. But what's big about it is that the cash flow might double, right? Maybe you're only making $150 cash flow. If it goes up $150, you're doubling your cash flow. So these minor differences in rent rate may not sound like a big thing, and this is not minor. If you're at point one versus point, if you're at 1 versus point 0.5, you're literally double. But that means that your cash flow is exponentially higher. Candidly, in a lot of states, you can't cash flow pretty much anywhere, right? It's just not going to happen because the home prices are so high and the rents just can't keep up with it. But that is a big difference here, and I think it covers some of the drivers, right? The average home price in Texas, if you're looking at Houston and San Antonio, it's right around 300K, whereas the national average is 420, and that includes the small and large across the U.S., right? And then that job growth is probably the most exciting thing.
Yep.
Talking 2 to 3x the job growth of the national averages, and that's because so many of these big companies are moving here. It's to Jeff's point earlier, employer friendly environment, and that means a lot better opportunities for the employees out there too.
Yeah. If I can kind of summarize, because we've been talking about Texas, and we have a few more slides about Texas, but just putting it in real world conversations that I hear and that people have, that I have as well. Like people come in and say, "Hey, it's not a good time. The market's not a great time to buy to get in." Right? They for some reason they feel like this is not a great market. Maybe it's because rates are not at 3% or whatever the case may be. But as an investor, you have to have the attitude that every market is a good market to buy in. It just matters what your strategy is. Is it a good time? Is it a good flip property? Okay, buy it and price it appropriately. Make your offer. Is it a good rental property? Is the cash flow okay? The cash flow is X. Maybe it's not as much as you'd like, but all of the financial indicators and economic drivers are pointing, up and to the right. Your cash flows are going to increase over time. It's a booming state to be in. for all of the reasons we talked about. So don't let, I guess, negativity creep in. There's always a good time and a good way to buy properties. You just have to be smart about it. Don't take yourself out of the market because you think it's a quote unquote bad market.
All right, next slide. So this was a very interesting chart. This JBREC and Kiavi, or they do polls of people gathering. It's kind of like a sentiment poll
Yeah.
from flippers, and they've been doing this since 2023. And you see the numbers here, right? They're asking people, do you plan on flipping more homes next year? Roughly the same or fewer homes, right? So you can see the momentum here. 2023, only 40% of flippers were saying they were going to do more the next year. 2024, that number jumps to 49%, a significant jump, 20 something percent, right? Then that 49% goes up to 66% the next year. That's a big jump. And then this year, 71%. So 71% of flippers are saying they think they're going to do more houses this year. Only 19% are saying the same. And then a minuscule 10% say that they're going to do less. So the people that you have to flip a significant amount of homes in order to be in this poll. So these are the premier flippers, right? It's not a person who's doing one house a year. These are experienced people that know what they're doing. They know how to read the markets and make good overall business decisions. And these groups are saying that they're going to do a lot more next year. A lot of different factors for that, um, many of which are kind of detailed at the bottom.
Yeah.
Perception of price stabilization, hopefully lower financing costs, although we have big jumps in rates last week. There's no doubt it's a fluctuating market, but I think overall, with the Fed chair change and some other things coming up in the not too distant future, I think there are going to be some rate reductions over time, although we aren't seeing it at this exact moment. And then the tax deductions for renovation expenses. There's some ways in which you can get I think it's 100% depreciation in year one and some other things like that that can make things very attractive as well. There's a lot of reasons for people to get into that. So,
Yeah. The only thing I would add is if you look at that little bullet point down there, kind of what we were talking about, flippers in high inventory markets, which we are in a high inventory market here in Texas, face pricing pressures, underscoring the need for conservative underwriting and close attention to local markets. So, kind of what we were talking about earlier, just focus on the buy. There's plenty of opportunity, tons of inventory. So you're going to have to deal with that when you sell these properties. Like Wade said, there are strategies to try and really cut that down based on how well you do your projects and your plan. But it also presents great opportunities to buy as well. So you just got to be smart on both sides.
next slide. So I think, this slide is really, there's a couple different ways to look at this, but one good way to look at this is that, like what things are mattering most to homeowners. I think this is a little bit of a homeowner evaluation, if I'm understanding it correctly. But if this matters to homeowners, it also really matters to people who are going to buy the home after you flipped it, right? After you repaired it. So this is not uncommon information, but I have seen times in the past whenever kitchen remodeling might be a little bit more emphasized, but it does seem like the bathrooms are really getting a lot of attention at the moment, with kitchens not surprisingly being second. Um, Outside of that, I don't see any like super actionable information, but I would say that in my opinion, this would tell you that you really want to do the bathrooms incredibly well and the kitchens. But at the moment, it seems like bathrooms are at the top of that ranking.
Yeah. One thing I'll point out, and it's really more so, there's one down at the bottom, and what's not on here is if you look down at the 2.1 second story additions and just adding square footage, like you really have to know what you're doing. Like you need to be experienced, builder quality type of a contractor and make it make sense to do something like that massive. I know a lot of folks, sometimes when they first get started, they have big eyes and big plans, but massive changes like that, adding square footage, adding a second addition, you really have to make sure you thought that through. You understand what it's going to take to do that. You have the experience. Your GC is experienced, and honestly, you should be experienced at understanding how that works. Because what if your GC, I don't know, walks away? Then you're stuck. So I really would be pensive on things like that.
So the rental vacancy rates, you can kind of see like they're often much lower whenever rates are higher. So this chart tells me a little bit about the desirability of buying flip properties or and also rentals in general. So the vacancy rates are up a little bit, but not outrageous compared to where we've been recently in a lower rate environment, right? So a little bit of uptick, but I don't think it should feel disturbing relative to where we've been over the past. We're still definitely below the numbers from late 80s all the way through 2015 or something like that, right?
Yeah. These are pretty minor changes. Also, you're going from, I don't know, 5.5 to 6.5 or 7. Like, it's not a huge swing.
Yeah, it's a narrow band. That's a good point. So interest rates have been an interesting story. Jeff, tell us about what we've seen the last couple of weeks.
So yeah, this 6.22, is already out of date, right? So rates, I think rates are extremely volatile right now. When the war happened, or whatever you want to call it, in Iran, like, rates immediately blew up 50 basis points. Um, they were. I looked at a chart. They were just hovering, like, right at. This is for owner occupied 30-year mortgage. So obviously investor rates are a little higher, but for a regular typical mortgage, they were right at 6%, maybe like a little bit below. And like today, I think that looks like the published rate was 6.55. So they've gone up 50 basis points in just 30 days, and it's primarily because of the instability. Um, Unfortunately, it's creating energy inflation. And so I think that's got people fearful that even though we're going to get a new Fed chair, and before this happened, I would have bet a lot of money they were going to cut rates. I think they're kind of so sure now because of the
Sure.
inflation. They might
Hmm.
be less likely to do so. Um, so it's extremely volatile. It's going up and down. Like, every little thing that happens in the news over there, rates move. Like, we obviously we do long-term loans as well, and we get updates quite a bit from our secondary market team that says, things are all over the place.
Yeah, the best advice that I think you can get is like it's a dangerous time to try and play the market. Uh, if you need to get out of a hard money loan, uh, I strongly encourage you to lock as soon as you're ready to get out of there, because the swing between the hard money interest rate and the permanent rate is normally pretty significant, and you don't know what might happen. You might get stuck in that at a much higher rate in 30 days or something like that. So don't step over dimes to pick up pennies, in my opinion. And then the other thing that I would say is if you're looking at doing a straight refinance and the numbers are right, you got to lock it right away, because you could totally, like, I mean, rates went up very significantly in hours last week. So my advice is to try and lock in this environment so that you have the safety and security that's going to make you feel better overall. As far as just the trends, I think some news came out that it doesn't, there was an announcement a while back that the Federal Open Market Committee is saying that they weren't going to budge on their benchmark rates. So that's not surprising for this last meeting, um, because inflation is a big driver. There's some energy price related inflation that's definitely kicking in right now. There was a very good success story for inflation for some time. Unfortunately, we didn't get the rate reductions we were all hoping for, because it was a very, very good story. But now recently, it does look like inflation is coming up, so that we might have missed some of the boat on that, unfortunately. But there may be some changes whenever the new Fed chair comes in. But just a friendly reminder to everybody: just because the Fed lowers rates, it's not a direct correlation. It can influence rates, but really what drives it is the 10-year Treasury bond yield. That is going to be the biggest factor that drives mortgage rate, and then there's a spread there, and that's normally around 2%, but that's really based on risk as well. So that spread can get larger in moments of instability like we have at the moment. So whenever you look at that, that's what those factors all end up in what we're looking at as a mortgage interest rate. So the spread is a little bit higher than it's often been in the past. The bond holders are wanting to get more of a premium, and that's what we're seeing at the moment. So, do I still anticipate rate reductions later in the year? I tend to lean yes. I don't know that this is going to be an elongated military situation. We all hope it's not. I think they're hoping to have something a little bit more brief, certainly more brief than Iraq or Afghanistan. Let's hope. But hopefully later in the year there's going to be some interest rate improvement. But at the moment, I would not bet on it in the short run. That's for sure.
Yeah.
All right, next slide. So this is something that we love to keep an eye on, and a lot of the earlier slides talk about this, but this is a very granular breakdown from each of the major metros, and the trends here are always interesting. If you look in the least affordable, and this is basically a less affordable chart, a least affordable chart. It's not the inverse of that. You look at the numbers where, for example, in Los Angeles, 83% of your total income goes towards the average mortgage payment. So that's like a impossible to manage number, right? That's why so few people are able to own properties out there. But whenever you look at the appeal of like major cities, like top 6, 7 population cities with all the attractions that come along with that, restaurants, nightlife, sporting franchise, different things like that. You're looking at Dallas and Houston really being incredibly affordable compared to some of these other major cities, only being at 44.5%. Houston, very attractive at 37.14. The one that really jumps out though is San Antonio. We talk about this all the time. The average person in Houston earns as much as the average person in San Antonio, right around 69.3. I mean, it's man, we're
Yeah.
talking what,
Same.
$5 different?
Yeah.
Very, very minimal difference. But the average home price in Houston is 350, and San Antonio is down to 264,990. So, I mean, we've been talking about it for a long time, and that's one of the reasons I think San Antonio is got the highest appreciation going at the moment. I think there's still a lot of upside from there. Um, there's a lot of other reasons that I think Houston has higher home prices, but that is a pretty attractive difference there for sure.
Yeah. I would have never get. I guess it's been this way ever since at least since last year. I would have never guessed Corpus was more expensive than San Antonio. But um, that man, I
The
got
water, maybe? I don't know.
yeah. I gotta Detroit, Cleveland. Like these are I don't know. Like these are major cities that have huge populations, and their average prices are 110, 125. That's just mind-boggling to me. Um, but I'm just staying focused on Texas. Obviously, like you said, it's kind of a testament to the affordability that we have, all of the
Yep.
great amenities of living here in Texas, and you don't see us anywhere near the top 10. Like the most expensive city we have is Dallas, and it's 18th. And Dallas is one of the largest metros in the country. So you get all the
Yeah.
great amenities living there, and you're 18th. Get down to Houston, 33rd.
And they really slice up Dallas into so many different sections here. You look at Dallas, you got Dallas proper, I guess, at 450. You got Irving, 420. Plano, very high at 515. Arlington, 340. Fort Worth, 399. So a lot of Garland. That's part of the greater Dallas area, 309. So whenever you kind of bake them all in, I actually think it's a good bit less when you probably pull it in all those numbers.
Yeah.
Houston is just a lot larger. Like the metropolis is not as big as Dallas, but whenever you look at, just the Houston proper, it is a very, very large area that includes a lot of smaller home prices as well.
Yeah. I mean, we didn't talk about it, and I think it was on one of the slides, but like doing rental properties in Dallas, the tertiary markets are where it's at. That's where you get the much more affordable properties. better cash flows. I mean, you can get good deals in Dallas. Don't get me wrong, but like most of the deals that we see come across our desk are not in Dallas. Dallas, they're in the surrounding areas.
100%. Okay. Well,
A little early, 10 minutes.
that's all right. A little more efficient than usual. Do we have any questions we want to cover today, David?
Yeah, so we do have a question from Chris. And this is a little specific, but he wanted to know he was looking at houses in McAllen. And he sees, it's pretty common to see houses on the market for 100 days. What would that kind of be? What would that tell you about maybe the market out there in McAllen since we don't specifically cover it in our data in the beginning?
I don't know that that number is drastically different than some of the other major cities we just covered. So I think the story is probably comparable that, you know, you want to get a good price where you can put enough into the product to have a great product and try to get it sold in under that 100-day period. And if you put out a great product and you're willing to be responsive to the market on your price, I don't think it should take that long that often, right? You just have to be willing to lower to a price where you can get it sold. It is softer than usual. We're all aware of that. You should bake in longer hold times, but you should be able to get down to a price that can eventually work.
Yeah. For as a reminder, San Antonio is 101, so it's very similar.
Yeah.
Gotcha. Thank you.
Anything else?
Next question. What does a good deal look like today compared to 12 to 18 months ago?
I don't know if they're. I'll give my opinion, Wade, then you can give yours. I don't think they're that different 12 to 18 months ago. I think the deals today are pretty similar. I think if you're going to flip, you might want to get a slightly lower price because, like we said, your days on market. There are tricks to getting it down, but it's probably going to be a little bit longer than before. But I think the biggest difference is deals now versus deals say 3 4 years ago when the rates were much lower. Your cash flows are lower, but like I said, people got out of the game, so there's less competition. So a lot of times the cash out of pocket is significantly lower. So while your net cash flow may be $100, $150 as opposed to $400 or $500, your return on investment is oftentimes greater because you're spending way less money out of pocket. Those days back in the day, you're spending 30, 40,000, sometimes even more for rental properties. Now, you can see some deals which much less out of pocket.
Yeah. I, yeah, I think to your point, 12 to 18 months ago, we're in a very comparable environment. I don't see drastic changes between those two. Um, I think the biggest difference was back in COVID. I mean, it's a totally different environment, both on rentals and on flips. But I think last 12 to 18 months, we're in a very similar market.
Yep.
Gotcha. Thank you. And then let me see. Uh, One other question. We had was and this one's a kind of one that you can debate on it as well. But are we in a buy now window, do you think, or do you think there may be more opportunities still ahead? What do you guys think?
I'm a big believer that the best investors treat it a lot like stock the stock market, right? Just kind of dollar cost averaging, which basically means consistently buying if you're buying rentals is just the right move. Trying to time the market, it's just very difficult to do, and you don't know where the market's going to go. So just continuing to buy good opportunities. Then on flips, I think the market is going to be really good whenever rates come down a bit because there's a lot of pent up demand. And but I also don't think it's a bad time now if you get at the right prices because we're in a buyer's market. So to Jeff's point earlier, I think there are ways to make money in real estate in just about any market. It's just the game changes based on where you're at. Like if you're in a super low rate environment where everything's flying off the shelves, you can pay up a little bit more without too much risk because there's so little supply. There's multiple offers on everything, and it's just a different environment. You have to be reactive to the market that you're in, but just make good decisions based on that market.
Yeah. The return on the ROI is the key. That's what you got to focus on.
Yeah.
Gotcha. One follow-up with that question. Talking about ROI, what's one tactical move you can make to really improve the ROI some other investors might be able to do? Maybe something that you guys have seen that could improve their return. One kind of tactical tip or something like that.
In rentals and in flips, it's really looking at the market and not over rehabbing. Like you have to make it the most attractive house in the area, but I would not go beyond what the market will bear, right? I see people sometimes that you know, they get really passionate about trying to put out this amazing product. Like they started off with a $60,000 repair budget they told us about, and they're like, "Well, I spent an extra 20K on it." And I don't know that you can get that lift because the comps, you can get a little bit more. Like we said, we have that one client who kind of sets the market. You can get a little bit more, but you can't get that much more. So you have to make sure that you're rehabbing to what the market really desires. And you have to look at the latest trends, like what are the homes that are selling fast? Not every home. If you just think about it logically, if you have an average 100 days to sell, there are going to be homes that are taking 150 days, there are homes that are taking 50 days, or homes that are taking 25 days. What are the characteristics of the homes that are taking 20 or 25 days? And normally it has a little bit to do with price and a lot to do with product. And so if you can put out an excellent product, I think that makes a difference, but you have to look at what's appealing in that particular neighborhood. I remember we flipped a property a few years back in a neighborhood where I did not fully understand that it was a historical district, and there were some what I perceived to be some pretty ugly bathroom tile, but that was really on trend in that area, and we should not have pulled it out. And it cost us a lot more money. We could have just retained it and actually executed better because of what people in that particular market wanted. So you really have to understand that market.
Agree. I
Gotcha.
saw,
Thanks,
yeah,
Wade.
I saw a question about what zip codes are really good for flips. I don't know about you. I don't. I couldn't tell you like a zip code. I think you just look at neighbor. I would focus more on neighborhoods than zip codes. Finding good deals and focusing on the neighborhood more so than just the zip codes. I don't know if you have a different opinion. I know some wholesalers really love like focusing on certain zip codes, and that's fine. I really couldn't tell you.
Yeah, I think you can become, as an individual, you can become an expert in a certain area for sure and know what people want. I think you're limiting yourself a little bit if you're trying to focus just on a finite number all the time. But if you have very good systems, I have heard of some people that are successful that way. Like they really know this area, what the people want. They know that they can get a premium on it and all that stuff. But I can't tell you, I think, with any valuable information on what the best zip codes are. No.
Yeah.
We do loans all over the state, so we see successful deals all over the state.
Gotcha. Thank you, guys. So that looks like it's all of our questions. I did want to announce our winner for our drawing today is Kate Quee. So, Kate, thank you for tuning in.
Kate.
Thank you very much. I do want to remind everybody that there's an apply now opportunity here at Catalyst. We are able to get you pre-approved for all those products Jeff mentioned earlier, from hard money loans, conventional loans, DSCR loans, all with one fully licensed loan officer, highly qualified, trusted advisor to walk you through the process. And it is a soft credit pool in order to do that for our top clients. So we'd really love to have an opportunity to do that. No harm, no foul on a soft credit pool. Will not impact your scores or anything like that. And it's a golden opportunity to find out what you can do in today's market so you can start investing right away. So we'd love to hear from you. All right. Thank you, everybody, and have a great day.
Thanks, guys.